start right here. And then before I send this video out, I'll trim what I was just talking about. You must be glad to get past present value, huh?
Yes.
That was kind of tough. All right, here we go. Here we're issuing stock to the public. We're going to raise money by issuing stock. We're not borrowing money now, Maria. That's what we did in chapters 9 and 10. We borrowed. We issued a bond, okay? And there's some advantages to doing that. Some advantages with a bond. One of the advantages was we didn't give away any ownership in the company. That was one advantage. Here, with issuing stock to the world, it's easy to become an owner of a corporation, easy to buy stock, it's easy to transfer. And corporations have a limited liability. You can't sue the officers. You can sue the corporation, though. Okay. Hey, good morning, Nicole. It's me, you, and Maria so far. Okay. And we were just starting right now. Okay. We began with, you walked in at the exact right time. We were just getting going here, talking about the advantages of a corporation. So we're all on the same page. Ownership of a corporation. You own common stock. You own stock. Let's not worry about what type.
Something happened. Bob, you're muted.
Yeah, I think you're muted and it's freezing, right?
Okay.
There we go.
Thank you.
I think.
And your pictures keep disappearing, so I keep thinking you're not there. Okay.
Mine, it kicked me off. I had to log back in.
Oh, okay. All right.
I don't know. Everyone's on the internet at the same time in this house, so who knows?
Here we go. Hold on. Okay. All right. And let me just do one other thing. Okay.
You know, they made it where every single thing relies on the internet, but they're not like improving the internet to make it available for all devices. You know, it's really annoying.
a lot of user error, if you know what I mean, too.
Okay. Well, like you can't use a TV now without having it connected to internet.
I know.
You know, and I can't use my TV at the same time as my internet, the same time as my phone, the same time as my kids. It's like I'm constantly yelling, turn off all your devices, because it doesn't work.
I know. You know, the old joke used to be when I was much younger, the only reason you had children was because they could work the VCR for you. It's kind of the same thing now, you know? Okay. All right, here we go. Chapter 11, take 3. You ready?
Yeah.
Stock. We're not borrowing money. You heard this already, right? We're not borrowing. You can see the slide, by the way, right?
No.
Yeah.
I mean, we could before, but now, no.
I've only got one set of slides to do. You see it now?
Yeah.
Okay. Hey, good morning, everybody. Welcome to chapter 11. We'll get started now. We won't waste any time here. And here we go. Chapter 11 is about issuing stock to the public. I think it's more digestible than the prior 2 chapters where you had to worry about interest rates and the time value of money and present value and discounting future values back. Here, we're issuing stock to the company, to the world, rather. The company's issuing stock to the world. Advantages of a corporation, huh? One is the corporate shield. You can't sue the officers personally, You can sue the corporation, though. If you own stock, it's easy to sell, easy to buy, simple to become an owner. All you do is click on, I want to buy 10 shares of IBM, huh? It's a separate legal entity, and it can be sued. A corporation can be sued, enter into contracts. But the corporate officers, for the most part, cannot be sued unless they've done some malfeasance. And that, believe it or not, is a big change with Sarbanes-Oxley, the act we talked about earlier in the course. If you own stock, you might have voting rights. You might have the right to vote for the board of directors. You might have the right to approve bonuses for people. And you might possibly get some dividends, proportionate distributions of profits. You might get dividends. Who knows? And if the company goes bankrupt, well, you'll get a shot at what's ever left over to some extent. Stockholders own the corporation. We should know that. And it's the stockholders who elect what's called the board of directors. The board of directors. That's a group of external and internal managers. And the reason you have the external people on there is that they're an arm's length removed, and they can be impartial, unbiased. And together with the internal managers, the board of directors are the ones who approve the hiring of the corporate officers. And just as important, it is the board of directors who decides whether or not a dividend is to be issued. So let's take a look at our three terms here. Simple terms, but we need to get real familiar with these as we go along. This circle here represents the authorized shares. When a company wants to issue shares to the public, raise money that way, the state will say, you are authorized to issue 1 million shares, say. So this big circle represents the authorized shares. Here you can see they've issued half of the shares. So the shares that have been issued, meaning sold in the IPO to the public, those are the issued shares. The ones that have not yet been sold are called the unissued shares. When you're talking the IPO, the initial public offering, the proper term is not to sell the shares, you're issuing the shares. We want to save the word sale for the private market, for the secondary market. And they're breaking these out a little bit more. We said that the total circle represents the authorized shares. Half of them have not yet been sold to the public. The company is deciding not to do that yet for whatever reason. And now look, the outstanding shares are no longer half of the authorized. They're only 1/4, and 1/4 are now sitting in a block called treasury shares. Treasury shares, treasury stock. Treasury stock are shares that have been reacquired by the corporation. And how did they reacquire them? The same way you and I acquired them. They had to go out into the secondary market and buy back those shares at whatever the market price was at that point in time. And companies have reasons for doing this, some good, some bad, and we're going to talk about that a little bit later this morning. Earnings per share. This is the one thing everybody who owns common stock wants to hear about. You want to hear that they had announced record earnings. This company here, Whole Foods, on income of almost $500 million, a little over $500 million, divided by these outstanding shares, they earned $1.57 per share. You could argue that that's $1.57 they now have available for dividends. So when you see $1.57 per share, that may be good, it may be bad. A lot of it is driven by expectations. One of the stocks I own, I bought some more at a real bad time. I bought it the day before they announced earnings, and they were supposed to earn $1.57 a share, but they only earned $1.50. And that short-term miss just drives the market wild. And the stock took a big nosedive for a while before bouncing back a bit. Earnings per share, they're just showing you a couple companies in the food world. Whole Foods went from 128, 148, 157. That's progress, I guess, huh? Safeway, 48 cents, and Fresh Market, $1.30. Okay. Here we go. Common stock. I was saying before we turned the button on here, common stock. You call a stockbroker right now and say, I want to buy 100 shares of General Motors. The stockbroker is not going to say, is that common stock or preferred stock? He or she is going to assume it's common stock. Okay. Common stock. This is your basic voting stock. This is the voting stock with a dividend set by the board of directors. The board of directors can raise the dividend, lower the dividend, eliminate the dividend. Common stock. It ranks after preferred stock in different ways. After preferred stock in different ways. For example, preferred stock gets first shot at dividends. If the board of directors said we're going to give out $1 million in dividends, the million will go to the preferred shares first. Then whatever left over goes to the common shares. So the common shares are the basic voting stock that most people buy. Preferred shares are a totally different type of investment. We'll take a look at that. Par value is the nominal value per share. It has nothing to do with the value of the stock, has nothing to do with the market price of the stock. It is just a legal requirement. It can be a penny, it could be $100, it could be whatever you want, okay? It has nothing to do with the market value. The only thing you do with the par value is multiplied by the shares outstanding, and that number represents the common stock line on your balance sheet. That's all you do with the par value. Par value is not good or bad. There's no meaning to it other than a legal requirement. And I call your attention, par value does not have anything to do with the market value. And some states, under some circumstances, don't even require par value. Excuse me. So we're accounting for capital stock. Early in the course, when we learned about stockholders' equity or just equity, we learned about contributed capital. Somebody begins a business, even a corporation, they throw their own money into it. Here, we're raising money with a stock issue. We issued 1,000 shares, say, at $1 par value, and those shares brought in $100,000. That difference of 99,000 goes into capital as well in an account called capital in excess of par. It can be called additional paid in capital, paid in capital in excess of par. So you have two equity accounts here: common stock, credit balance, credit normal balance, simply the multiple of the par value. If that $1 share sold for $10, you would see $9 in this capital in excess of par. And the other part of stockholders' equity is the retained earnings. And the retained earnings represents the total of all the income and losses this company has had since its history began. When the company began, by definition, there was zero retained earnings. The first year they earned $1 million. You have $1 million in retained earnings. They earn another $1 million, etc. This is accumulation of income losses since the company began. It can be reduced by dividends. So here we go. The sale of capital stock. The initial public offering is the first time the corporation sells. I like the word issues better, huh? So initial public offering simply means the first time they sell stock. Suppose they issue all the authorized shares, but they want to raise more money. They can go back to the state and get permission to authorize more shares. And that's just called a second issue, a season new issue, a subsequent issue, handled the same way. The same way. Okay, time for some journal entries. All right, now we're going good here, huh? Trader Joe's issued 100,000 shares of par value stock, $1 par. What do we say the only thing is you do with the par value number?
You multiply it by the shares, the leftover shares.
Exactly. You multiply it by the outstanding shares, which in this case is 100,000. So that's going to be your credit to common stock. You see that, Maria?
Mm-hmm.
That's all you do with that par value. Well, how much did the public value these shares? They didn't give us $1. They gave us 20. So we got 2 million in cash. Debit that.
Mm-hmm.
And the excess goes into capital in excess of par. Okay. Excess of par. What is the secondary market? Those are the people who own the shares after they've been issued. The secondary market. Maria, you buy 100 shares of Coca-Cola today. You're part of the secondary market. You want to sell those shares? You go to your stockbroker, or you can do it online and say, I'm selling these shares. And you sell it to another person who is in the secondary market. The secondary market is the public, the people who have bought the shares.
Mm-hmm.
And apparently the way this guy sells the shares, he walks down the street, he walks up to somebody, says, hello, I like to sell my shares, okay? Now, let me talk a little bit about this. And I'm going to get into the politics a little bit here. Companies issue stock sometimes for employee compensation, okay? If Sonic does not have new stock to issue to cover stock options, they may have to come up with another share or another issue, or they may have to buy some stock back. Let me break this narrative up a little more clearly. Stock options. We're not really going to talk about this other than to explain them. A stock option is this, Nicole Maria. You work for me, and our stock today is trading for $5 a share. You work for me, and I say, hey, congratulations. Here are 10,000 stock options, and you can buy the stock right now, but you have to pay $10 a share. Well, obviously, you're not going to do that, but the stock options might have a life of 5 years. So what you're doing is one reason I'm giving you these stock options, guys, I want you to work real hard for me and help us make a successful company. Now you have the option to buy it at, I said, $10. Well, the stock goes up to 7, 8. When it hits 11, you can then issue your stock option and buy it for 10 and make $1 a share, or wait until it goes way, way up. So stock options are a very nice thing to have. I used to get them a little bit at Thomas and Betts, not much. I get like 100 stock options, but they were nice. And fortunately, the company, pretty much always made money. Repurchase of stock. Hello, treasury stock. Sonic buys its own stock back from the public. Okay. Companies do this. Companies do this sometimes. Sonic buys its own stock. How do they buy it? The same way you and I buy it now. They have to go to the secondary market and find somebody who's willing to sell it. And there are a couple of reasons why companies buy treasury stock. And I'm going to say some good, some bad. If you own a stock, like I own Coca-Cola, a couple of years ago, about a year ago, Coca-Cola announced a big stock buyback. And it turned out the reason for that was they did not have enough shares available to pay their hotshot top executives. So they were forced to buy their own shares back. So they had the shares to give to people who were earning stock options. When a company buys stock back for that reason, that doesn't help anybody. It doesn't do anything to jolt the economy. There's no real value there other than to the people who are getting those shares, okay? So to me, that's kind of the dreary reason, the reason I don't like. But suppose you're Coca-Cola and you're looking at the price of the stock, which is now around $50 a share, and you're looking at your projections and you know your business better than anybody, and you think your shares are undervalued. You think with some of the products you have coming on the market, you think the stock is going to go up from 50 to say 80. Well, if you have money to buy back that stock, that's a good reason. That means that the company is optimistic about their future. And if I see Coca-Cola buy back stock for that reason, I'm pleased and optimistic. Getting to the politics a little bit, a couple of years ago, when President Trump passed one of the largest tax breaks for the wealthiest Americans. He passed a tax break that was designed for the wealthier and for corporations. And that sounds like a good thing, tax breaks for rich people. And the theory is that money will trickle down to us, poor folks. The idea was that these corporations would take that tax savings, which was considerable, and use it to open up another store, another factory, invest in some new products. It was supposed to jolt the economy. But you know what many, and I'd say most of these corporations did, guys? They did this. They went out and they used it to buy their own stock back. It was like free money. They bought their own stock back and then just gave it to themselves as additional compensation. So treasury stock, we'll get there. Oh, we're there. Treasury stock. Here we go. When stock is reacquired, the corporation records the treasury stock at cost. Treasury stock has no voting or dividend rights. Treasury stock is not even an asset. It's not an asset. When a company buys back its own stock, you are going to debit treasury stock, which is a contra equity account. You see that, guys? It's a contra equity account. Now, that seems strange, doesn't it? We purchased our own stock back, and in so doing, we reduced the net worth of the company. How could that be? Well, the reason is pretty obvious when you start to talk about it a little bit. A company cannot buy and sell their own stock and claim a profit. Company cannot trade in its own stock and pretend that its own stock is an asset and put it on the balance sheet. No, when a company buys back their own stock, they have reduced their equity. Treasury stock is not an asset. I guarantee that's going to be referenced on the test. So let's look at the journal entry. TJ's reacquired 100,000 shares of its common stock at $20 a share. So take a look at the journal entry. Not too tough, huh? They reacquired their own stock. They cannot put it on the balance sheet as an asset unless they want to go to jail. That's the type of manipulation that these rules try to prevent, huh? So notice again, they debited treasury stock, which is a big X there, contra stockholders equity account. Okay, so they're holding these shares now. Let's see what they do next. Well, they bought these shares May 1st, and sure enough, they reissued them at 30. They bought them at 20, and this is the good reason you might see a company buy back. Okay, our stock we know is going to go up. When it hit 30, they got rid of 10,000 shares. They're saying reissued. That's not the right word. They sold them back at they sold it to the secondary market, okay? So let's see what happened here. Well, we know we dealt with a sale now of 10,000 back to the public, and we sold it for $30 a share. 30,000 times 10, $300,000. What did we pay for these shares? 20. They were in our financial statements at $20 a share. So that's how much we sold. That comes off. And now the capital goes up. Now we increase our capital because we have made money on the deal. There's no question we made a profit, right? But you can't call it a profit. A company cannot profit by buying and selling its own stock. It would lead to all kinds of malfeasance and fraud. So any excess profit, if you want to call it that, simply goes into capital in excess of par. What do you think, Nicole? You follow this? Okay.
Yeah.
You good, Maria? Question? No. Okay, we'll keep going.
I think you're on mute. That's yeah.
How can I be on mute?
Not you, Maria.
Oh, Maria. Okay, all right. I thought I was on mute. Okay. You're okay. You're okay if I continue along, Maria?
Yes.
Okay. When do you get into Cornelius 240 class, where she's very strict and everything goes smoothly? Treasury stock. Okay. Let's talk about dividends. Dividends. This is an interesting area. Dividends. Companies don't have to pay them. A company can make $1 million per share, and if they're greedy, they won't pay a dividend. They don't have to. Not legally required. Not legally required. Guess what? You have to have enough retained earnings and cash to do it. Okay? Dividends. They are announced or declared by the board of directors. Okay? You never have to pay a dividend. But when it's declared by the board of directors, and what happens is the board of directors have a meeting, they decide to they're going to give out a dividend, and they run to the press. They hold a press conference. And IBM is proud to announce we're giving out $2 a share dividend. The minute they declare it, it becomes a liability, and now they have to pay it. So the declaration date is one of 3 dates we need to understand. The declaration date creates this liability you see here now. You notice what we debit on this particular transaction? Retained earnings. All dividends, whether it's a cash dividend like this or a stock dividend, which we're going to review in a minute, no matter what the dividend is, you debit retained earnings. A dividend, by definition, is a reduction in your company's net worth. You're giving it away to the public in the form of a dividend to the shareholders. Debit retained earnings. Understand these 3 dates. Very important. Easy pickups on multiple choice questions, maybe, huh? The date of declaration, we just went over that. The declaration date, that creates the liability. It requires a journal entry on that day. Debit retained earnings, credit dividends payable. The date of record, no entry. What the date of record is, let me just see if they gave us a date here. Yeah, see, March 3rd is when they declared the dividend. But they might not pay the dividend until April 1st, okay? The day the dividend is to be paid is, let me say it more clearly, that's not quite right. The date of record is the point in time where whoever owns the stock on that day gets the dividend. If the date of record is March 31st, the people who get the dividend are those who own the stock at the end of that business day. So if you own the stock for 50 years and you sold it in the middle of the record date, you are not going to get the dividend. Okay? If you jumped in an hour before the closing and you scooped up 100 shares, you will get the dividend. The date of record. Your human resources department or your treasury department will provide a list of all of the people who get the dividend. Ex-dividend date, there's a little leeway around that. Not going to talk too much about the ex-dividend date, no entry. Date of payment, though, that's a key one, huh? Date of payment. They're not showing us the journal entry, but guess what? You're going to debit dividends payable here and credit cash. Okay? Cash dividend. I'm going to call your attention to the third bullet here. Stock prices often fall on the ex-dividend date or date of record. We'll call it the date of record, since the stock no longer includes the right to the dividend. And what you see once in a while is the public knows that a dividend is going to be paid tomorrow. They might jump in and buy some shares, and that has a tendency to increase the stock price. And there are people who look for that little window of opportunity. And also people who know that some of these people are going to get in and out and sell right away. And the next day or so, you might see a little dip in the stock. Not guaranteed. And here we go with the dividend dates again. Date of record, date of payment, date of declaration. And there's our journal entry that we didn't see yet, where they pay the dividend, huh? Dividends. Dividend yield. This is another metric people are always looking at. Dividend yield. Right now, if you took $1,000 and you put it in a CD at any of our local banks, you're not even going to get 1%, huh? So people looking for higher returns need to take a little more risk. And one way to do it is maybe buy some stocks or a mutual fund that regularly pays dividends. So let's take a look here. Whole Foods announced a dividend. They paid a dividend of 48 cents per share. So you get it 48 cents for every share you own. And when they paid the dividend, the stock was trading at $37.67. We divide that out, and you received a yield of 1.3%. These days, that's not bad. That's 0.5% better than you can get with a totally non-risky investment. So you take a little more risk by buying a common stock, and hopefully one reason you buy the common stock is to get a dividend. One reason. The other reason is maybe you don't want dividends. You want the company to put the money back into research and drive the price up. So let's see what we're talking about. Whole Foods. Well, the dividend 2 years ago was a paltry 0.6%. And then it went way up to 2.4, and it went down. But look at the stock price. The stock went way up and then came tumbling down. I don't know what happened to Whole Foods for those 3 years, but look at that. It was 48, and then it went up about almost 20%, and then it went down by, oh my goodness, 40%. So they had some tough times there. And they're looking at Safeway, 2.5%. Fresh Market, they don't pay a dividend according to this, but that might be a good thing. You're a common stockholder. Maybe you don't want a dividend. It's a listing you want. You want that company to drive every dollar they can get their hands on back into growing the business. Stock dividends. Stock dividends, huh? These were cash dividends that we've looked at so far. Stock dividend. Here, you're not going to get any cash. You're going to get more shares. Isn't that great? You're going to get more shares. But guess what? The amount of the value of your portfolio is not going to change. All you're going to do is get more shares, but they're going to be at a lower price so that you have the same amount of investment. Very simply, guys, you own 100 shares of stock at $10 a share. And the company says, congratulations, here is a stock dividend of 100 shares. You owned 100 at 10. Now you own 200 at 5. In other words, you have more shares, but the price per share has been cut in half, assuming it's a 100%. So assuming it's a 1-for-1. You could have a 3-for-2 stock dividend, a 5-to-1 or whatever. Okay. All stockholders retain the same percentage ownership. Well, is that a good thing or a bad thing for you if you own the stock? I happen to believe it's a very good thing. Okay. One reason companies give out stock dividends or stock splits is because the price of the stock has been going up and up and up. And it's psychology. Apple. 15 years ago, I wish I had bought 1,000 shares at $6, huh? Now those shares went up, and they went up to about $800 a share. You own one share, it's worth 800. Apple then split 8-for-1. I think it was 7-for-1. What was it? 8-for-1. Suddenly, you didn't own one share at 800. You owned 8 shares that were just worth 100 each. Why would they do that, you think? You have any thoughts on that, Nicole? Why would a company even bother to do that?
To raise the amount of shares that people own, maybe?
Yeah, you're on the right track. It's really psychology. You're a small investor like me and everybody right now, and you tend to think of buying shares in lots of 100. You don't have to do. You can buy just one share. But people typically think, okay, I want to buy 100 shares. And when the stock went up to 800, psychology, gee, if I buy 100 shares of this stock, it's going to cost me $80,000. Yeah. By dropping the price down, it makes it more attractive to certain investors. Wow, the price is $100 a share. That I can handle. Yeah. That I can handle. I can pay that $10,000. So that's why they do it. Okay. And stock dividends are typically a good thing. Stock split. You have 2 different types of dividends, small and large, and I'll go over that. Maybe not here, but we'll go over that a little bit. Small dividend is if the dividend is more than 25%. Large would be over 25%. In other words, if you're getting 1.25 shares for every share you own, that would be a small dividend compared to a large one. And there's a slightly different treatment. Some notes on dividends. Dividends, additional shares to the shareholders. It's distributed pro rata per each so that stockholders retain the same percentage ownership. So if you own one share today at $10 a share and they offer a 3-to-1, they give you a 3-to-1 stock dividend, you now own 300 shares at the reduced price. Par value doesn't change. The stock, now this is kind of baloney here, but maybe they're right. The stock market reacts immediately when a stock dividend is issued and the stock price falls. What they're saying is that as soon as the public sees that the stock dividend has been issued and the price is more attractive, the stock price will rise. I don't think that's quite the case anymore. And that's what they're saying. The lower market price may make the stock more attractive to new investors, okay? New investors. Stock dividends. Didn't we just see this slide, huh? I love how they throw this slide in again. All right. Stock dividend. I'm not going to go over this page in any great detail, but what they're saying here is we have 100,000 shares at $1. They issue a 10% stock dividend. 10%. So for every share you get, you're going to get 1/10 of a share. So it works out to 100,000 shares times 10%. That's 10,000 times the market share at that price. And that comes to 150, and it gets distributed as follows. Now, I'm deliberately going fairly quick with this because we're going to get back to it later in the week, okay?
Mm-hmm.
The point to be made here is, what was the equity, total equity, before we issued the stock, and what was it after we issued the stock split? Not stock split, but stock dividend. What changed? Okay, it had nothing to do with preferred stock. What changed was common stock is no longer 100,000 shares. It's 110,000 shares at a par value. And this is the amount of retained earnings. That was the cost of that was 750 here, retained earnings, minus the 150 that we will distribute, and the paid in capital naturally changed. The point is, stock dividends does not change the overall equity. It just shoves some of these elements around. Let's talk about a stock split. A stock split. It has the same exact impact as a stock dividend. If you got a letter today from Coca-Cola and said, we are announcing a 100% stock dividend. And then the next month, they said, we're issuing you a stock split. You, as the investor, have no difference. It's the same exact thing. The same exact thing. The only difference with a stock split, you don't need a journal entry. And let me show you why. You don't need a journal entry with a stock split because the board of directors are going to go in and change the par value of the stock. Under a stock dividend, you don't change the par value of the stock. Stock split, you do. So if you get an announcement that you got a stock split or a stock dividend, it has the same impact to you as the receiver of the split or the dividend. And the company, it has no effect on the company either in terms of equity changing. It does not. Okay. Now we're getting some good stuff. Preferred stock. Ooh. Preferred stock. Does that mean that it's better than common stock? We'll see. Preference over common stock. Preferred stock. Preferred stock has no voting rights, first of all. No voting rights. Preferred stock is almost like a bond in that with a preferred stock, the par value is important. Huh? So I just contradicted everything we've talked about so far. With a preferred stock, the par value is going to be expressed as a percentage. It's almost like a bond, okay? Except you don't have to worry about conversion tables and time value of money. Preferred stock. The reason it's called preferred stock is because simply when dividends are declared, the preferred shareholders get paid before anything can be paid to the common stockholders. Okay? It's almost like a bond. And there are two areas here. Let me try to be clear on. Dividend preferred stocks can be cumulative or current. Let's explain these. A cumulative dividend preference is what you want when you buy a preferred stock. It simply means if you don't get a dividend in 2017, when they pay dividends, they have to catch up on all the past years. Cumulative, you catch up on the past years, and the term for that is dividend in arrears. So if they didn't pay $10,000 to the preferreds in year 16, 17, 18, and now they have $40,000 available, that whole $40,000 will go to the cumulative preferred shareholders because they have to catch up with them, and nothing goes to the common. Non-cumulative, you're out of luck. Try again next year. And here is a good little exercise we'll finish up with, I think, okay? Here is a bit of equity information on Sonic. They had 110,000 shares at $1 par. That was after that stock dividend. Let's look at the preferred stock, though. They have two issues. They have a cumulative and a non-cumulative. So this is $100 par value at 3%. That would be $3 a share dividend. Notice that the preferred stock, it has a percentage, not a dollar amount. And the non-cumulative is only $50 par value, but it pays 6% or $3 a share. So each of these guys pays $3 a share. Dividends weren't paid last year. They didn't pay the dividends last year. So now it's a year later, and the board says we have $50,000 to give out in dividends. Who gets how much money, ladies and gentlemen? Let's take a look. Well, let's see. We have two issues, cumulative, non-cumulative. Let's do the non-cumulative. Well, maybe not first. How much is the par value in dollars? It was $3. Let me show you here. How did we get those numbers? 2,000 shares, the par value was $100, and it pays 3%. They did not get paid last year. There were dividends in arrears from last year's unpaid. So right off the top, the cumulative people receive $12,000. You go with that, Nicole?
Mm-hmm. I think so.
What about non-cumulative? Do they get paid for the prior years?
No, they don't.
They don't. They are only going to get paid for the current year. Cumulative preferred, you catch up on all the past years. Non-cumulative, you just get paid the current year. So now how much do we have left over for the common stock people? 32,000, right?
Mm-hmm.
32,000. Remember, there was 110,000 shares outstanding after the stock dividend. So these guys earned a dividend of $3 per share, and the common stock people only got 29 cents per share, huh? But I would still rather have the common stock, even at my age. Preferred stocks are very conservative. Here's what I'm getting at. This is a medical company, and they're on the verge of announcing a cure for baldness, right? I'll be able to rub this stuff in my head and I'll, have a whole skull full of hair one of these days, right?
Mm-hmm.
Well, as soon as this company makes that announcement, what's going to happen to the price of the common stock, do you think? Is it going to go up or down?
Up.
Of course it's going to go up. It's going to go way up. It's going to go up. It's going to go up to $100 a share. And at that point, these guys are getting big money. What's going to happen to the preferred stock of that company? Is that going to go up too, the preferred stock? Maria's shaking her head no. Yeah, Maria's right. No, the preferred stock is not going to move at all. Because the only thing the preferred stock does is pay you this 3%. Okay?
Mm-hmm.
So if the company comes up with a new great product, it's not going to affect the preferred stock at all. It's the common stock that's going to benefit. And that's why the common stock is a riskier stock than a preferred stock, because you may not ever get a dividend if the company doesn't make money, but you have the opportunity to really pick up some capital gains and flourish in the future. Okay. The only time the preferred stock prices change is similar to a bond. The only time the price of this stock will change is if the interest rates go down, maybe. If the interest rates went down to 2.9, then somebody would probably give you $102 for it. But preferred stock doesn't react at all to the market conditions, okay? Restrictions on paying dividends. If I give you $150,000, I want you to restrict your retained earnings. The point they're trying to make here is that the company cannot pay a dividend if they don't have the cash to do it or the retained earnings.